The NASDAQ-listed NVIDIA Corporation, ticker symbol NVDA, is currently trading at $184.49, reflecting a sharp intraday drop of $9.31, or approximately minus 4.80% as of the latest reading on November 13, 2025, during market hours. This significant downward move, pushing the stock from its open of $191.05 and nearing its daily low of $183.85, is the first thing that catches your eye. You look at that deep red bar, and the immediate common expectation is that this must be a reaction to some piece of genuinely negative company-specific news, perhaps a major downgrade or a lost contract, suggesting the artificial intelligence surge is already sputtering. But here's the unexpected angle. The intense selling pressure today is less about an NVIDIA-specific failure and far more about a broad-based, almost mechanical rotation and fear of interest rate movements creating a wider tech sector pullback, exacerbated by the simple reality that NVIDIA stock is heading into its crucial earnings report next week with a sky-high valuation that leaves absolutely no room for error. The market narrative is simple. NVIDIA stock is the king of AI, and kings don't fall easily. The reality we're witnessing today is a nervous market pricing in a perfect quarter and reacting violently to even the slightest general economic tremor, punishing high multiple names like NVIDIA stock, Tesla stock, and Apple stock the hardest as investors de-risk ahead of major catalysts. This downward slide is a technical warning sign, a signal that a significant portion of the recent volume, currently sitting at over 190 million shares, is being driven by institutional profit-taking and technical selling pressure after the stock struggled to break out of a recent trading range, a trend that is becoming more common in this high-volatility semiconductor sector. The general belief among investors and casual observers is that NVIDIA can do no wrong. They see the data center revenue soaring and assume the demand for their graphics processing units, or GPUs, is infinite. This belief is cemented by their ecosystem dominance through the CUDA programming platform, which effectively creates high switching costs for major clients and gives them a near monopoly in the highest performance AI training chips. The common ground is that NVIDIA is positioned at the epicenter of the defining technological shift of our time. Now, here is the contrarian take that challenges that common ground. While the long-term outlook for NVIDIA's foundational technology is undeniably strong, the near-term risk is that the sheer velocity of the stock's ascent has been fueled not just by solid company fundamentals, but by a massive speculative wave of capital that treats it more like a leveraged fund for AI than a traditional semiconductor company. The price-to-earnings ratio is still elevated, sitting at approximately 55, which means the stock is priced for continuous, exceptional quarterly beats, not just meeting expectations. The reality is that a portion of the recent revenue growth has been viewed with skepticism by some analysts who warn of circular revenue concerns, where NVIDIA invests in startups that then become major customers for its chips, potentially inflating short-term figures. This kind of nuanced, deeper analysis is what separates smart investment decisions made on platforms like Fidelity or Interactive Brokers from chasing momentum on something like the Robinhood app, where fractional shares can sometimes make it too easy to overlook the finer details of a valuation. Focusing in on the recent stock movement, the minus 4.80% drop today is occurring just days ahead of their November 19th earnings date. This kind of pre-earnings volatility is typical for a high-stakes stock, but the sheer size of the drop indicates major institutional repositioning. We've seen a noticeable uptick in selling volume, with trading volumes significantly elevated compared to the average. This selling is further compounded by a broader slump in the technology-heavy NASDAQ, where names across the board are seeing red, suggesting a macroeconomic pressure point, possibly driven by renewed concerns over sticky inflation and the future path of interest rates. When the entire market gets nervous about the cost of capital, speculative growth stocks, regardless of their individual strength, are the first to feel the squeeze. The daily technical indicators, such as the Relative Strength Index, which is now around 34, suggest the stock is approaching oversold territory, a condition that could set the stage for a short-term bounce. But right now, the momentum is decidedly negative. We're seeing institutional activity data showing a net negative in insider trading over the last 3 and 12 months with significant sales by officers, which, while often scheduled as part of automated selling plans, doesn't instill short-term confidence when the stock is under pressure. For those who use platforms like SoFi Invest or their individual brokerage to manage their own portfolios, this intense daily price action serves as a crucial reminder that even the most dominant companies are not immune to market fear and technical sell-offs. Historically, the NVIDIA stock narrative has been a masterclass in diversification. For years, the company was primarily a gaming GPU supplier, where their chips were essential for high-end PC gaming. This gaming segment is still a substantial business, showing moderate but steady growth, benefiting from the refresh cycle in hardware and the continuing appetite for higher-fidelity virtual experiences. But the real story for the past few years, and what drives the current stratospheric valuation, is the data center segment. This is where their GPUs like the H100 and the newer Blackwell architecture are sold to cloud hyperscalers like Amazon, Microsoft, and Google, and other enterprises building out their artificial intelligence compute capabilities. The data center revenue has grown exponentially, often surpassing the growth rate of their other segments and making up the lion's share of their total sales. The underlying business model is deceptively simple. They build the fastest, most power-efficient silicon for a critical, high-demand workflow, AI, and they lock in customers with their proprietary software ecosystem, CUDA, which effectively creates high switching costs for major clients. The consistency of this business execution has led to an impressive track record of beating analyst earnings estimates, contributing to the general expectation that this trend will continue indefinitely. Their profitability is also a highlight, with gross margins soaring to exceptional levels, which is a testament to the pricing power they command due to their technological lead. This fundamental strength is why even a nearly 5% drop on a random day is often viewed as a buying opportunity by long-term holders using platforms that offer investment help and self-investing tools. Looking ahead, the future outlook for NVIDIA stock is both incredibly bright and filled with complex risks. The primary catalyst, of course, is the continued massive build-out of global AI infrastructure. Enterprises are still only in the early stages of integrating generative AI into their products and operations, meaning the demand for their next-generation chips, such as the upcoming Blackwell systems, is likely to remain robust. Analyst consensus for the stock is overwhelmingly positive, with an average price target that implies a substantial upside from the current price. This optimism is fueled by the company's continuing technical lead and strategic partnerships. However, reality dictates that this growth trajectory will attract increasingly aggressive competition. AMD is a key competitor, with their MI300 series of AI accelerators gaining traction, particularly as they push a more open-source software stack, which could appeal to customers seeking an alternative to NVIDIA's proprietary CUDA. Custom chip development by major tech giants is another looming risk, as companies like Microsoft and Google are designing their own in-house silicon to reduce their reliance on NVIDIA and control their supply chain and costs, a process that is easier to manage when utilizing an intelligent portfolio service to track sector-wide shifts. The tension between expectation, unlimited AI growth, and the reality, geopolitical constraints, custom silicon, and margin pressure will define NVIDIA's stock performance over the next 2 years. The market expects a perfect quarterly report. The reality is that anything less will be met with a dramatic correction due to the valuation premium. The upcoming earnings report on November 19th will not just be about the numbers. It will be about the forward guidance and how the management team addresses these very real competitive and geopolitical pressures. Investors managing their portfolios with Fidelity Investments, Robinhood stock trading, or even Schwab Intelligent Portfolios need to be keenly aware that the stock's future is a calculation that involves more than just data center revenue growth. It must account for the erosion of their monopoly position in the long run. The transition to self-investing has made more people aware of stocks like NVIDIA, but true success comes from digging past the headlines and understanding the risk. The sheer volume of trading around NVIDIA stock is always a story in itself. In a few days, we'll get the details on their quarterly performance, and I want to hear your thoughts right now. Comment below which NVIDIA business segment, data center, gaming, or professional visualization you think will surprise the market the most in their upcoming report, and why. Your opinion on the long-term viability of their CUDA moat versus the growing threat of open-source competitors like those associated with AMD is something we should be discussing. Ultimately, what this period of volatility in NVIDIA stock tells us is that the market's expectation of flawless, perpetual hypergrowth has collided with